So, as real estate investors, we love inviting on other investors to the Real Estate Law podcast because we like to see how people operate. I think a lot of us started with that one rental unit. And maybe we bought it while we were working a W 2 job and we had extra money to buy an investment property. Or maybe we lived somewhere and then wanted to move and keep the property and rent it out. And we suddenly became accidental landlords. That could translate into a side hustle or career being a real estate investor, like has happened to us. Now, we've been involved in a number of deals over the years where either we're the one that owns the property or we are part of a pool of people that have been asked to contribute capital for preferred return on the property from people that we'd call syndicators. We spoke with one of those folks, Brad Shepard with Sugarhouse Investments, and we really dug into their processes as to both how they raise money and then how they evaluate investments, because those two things go hand in hand when you are doing a syndication deal. You have to be a really good operator. You have to understand the right asset class, the markets, the types of properties, time things well, and have a good track record for you to be able to take that to investors that have money that's sitting on the side. Maybe it's in their checking account or it's in a high interest savings account that they want to get a better return on it. They might be a high level investor, someone who's accredited and actually qualifies as an accredited investor, or there's some of these syndicators that are now working with non-accredited investors with a number of different criteria that allows them to accept their money for the investments. So, we have welcomed a number of people like Brad on the podcast over the years, and I wanted to highlight this clip because Brad talks about how they evaluate some deals and how they're out there explaining why people should invest with Sugarhouse Investments. So give it a listen.
I'm just curious how you build and maintain relationships with all these prospective investors, earn their trust, and earn the repeat business.
There's certainly a legal element to that because of the types of deals and the securities laws that go around there. But yeah, it is, I started with. They knew I have been involved in real estate for years, since the early 2000s. And so it was easy to go to them and saying, hey, I've kind of upped my game. I'm going up to this level now. We're talking about sophisticated operations, professional property management companies, and I'm excited about this. Do you want to come along with me? And so it was that type of a conversation with those, the people that I had known for a while. Now it's fun to go talk to people who I don't know very well. We've never met in person. It's been Zoom calls or phone calls. And they simply heard about me on a podcast. They saw me on Twitter. They've joined my email list. I sent out an email blast saying, hey, we've got this deal. Are you interested? And I'm getting a response back from somebody. I have to look and say, who is that? Mm-hmm. So then it's jumping on the phone call, make sure I understand their situation, their background, talk about my battle wounds, show them my scars, the lessons learned along the way. I'm never trying to sell. And I tell my investor pool, if it sounds like I'm selling, you can fire me because I'm doing it the wrong way. But I do try to be really authentic with them in what we're looking to do, what the expectations are. I have now gone the licensed broker dealer route, so I have limitations on what I can say as far as projected returns. Have to caveat the heck out of everything. So I do try to be very level-headed in setting the expectations with these potential investors, and that's served me well as far as being able to set the expectations low, exceed them with the actual returns. And then we get there, they get excited to want to play again.
I think a lot of us have been asked to be on people's deal lists, and we see it in Facebook groups all the time. Like, email or, put your email down below and you'll get deals like this from me. What's the borderline or what's the line between spamming somebody and sending out good deals? Like the people that are asking for my email address for their deal lists, are they just trying to build up their lists just for the sake of building their list up, or, how does somebody decipher between those two?
Yeah, that's a great question. So I've never gone the, Facebook ads route or, hey, give me your email list. I wanted this to be very organic. I love it when people tell me, hey, I heard about you on that I heard you on that podcast, resonated with me, would love to learn more. And they're coming to me asking for information. I do love to talk about real estate. I get excited. I start talking fast. Because because it is exciting for me. I love educating people about these opportunities. A busy professional who's got 1,000 other things on their shoulders, loves the idea of real estate, doesn't want to get their hands dirty with managing tenants, managing contractors, etc. and I tell them, well, here's how you can get those really attractive returns and the benefits without having to deal with the day-to-day stuff. It's really fun to see these light bulbs go off. And so as far as, what I'm looking to do, I don't need or want thousands and thousands of people on my email list. It's hundreds. We have a lot of repeat investors, and that's where I'm able to, what I can build my business on and feed my family on is that repeat business. And so it's not about thousands and thousands. I don't need to go everywhere and solicit email addresses. If I say something that in a tweet, in a Facebook post, in a lunch that sounds intriguing, and somebody says, "Hey, I'd like to learn more," just put your email on here so you'll at least see these new deals as they come out, and we can go from there. I try to be pretty low key about it, to be honest.
Yeah, I'd imagine. I mean, you also said early on if it sounds like you're selling.
I'm never looking to convince anybody. I don't want to convince you.
So what do you do then? Do you provide the data and the details and the numbers, and do you give any kind of analysis, or is it really just, presenting the deals to people and reserving your comment?
Yeah. So like the operator will come to us with their deck, right? Their investor summary deck for this particular property. I have to send it over to my compliance department. They bring out their red pen and cross off everything that I can't talk about as a licensed securities broker. And one of those pages is always the projected return, right? I can't sell off of a projected return being a licensed securities representative. And so it's all about, okay, with the caveat of historical performance is no guarantee of future results. I talk about the historical performance, how this team came together, the type of properties that they've got in their portfolio or that they've sold off, and their historical returns. Here's the deal structure. Here's the preferred returns. So we could say, that's not a guarantee, but there's projecting this is, you get paid that before the GPs can get any, any returns off of this. And here's how those line up as far as preferred returns versus past performance. Again, trying to keep the expectations low, but still kind of take, nodding towards, we are definitely expecting to do quite a bit better than just that preferred return. But you, Mr. or Mrs. Investor, I need you to do your own effort here in thinking through this, talking to your own advisors. Let me show you how to analyze this, why I think it's good, but I need you to do some of that work yourself so that you, on your own, get excited about this deal and want to participate in it.
That's different from some of the deals that have been presented to me, and maybe it's because I'm being shown deals that are not by a licensed professional. Maybe it's just like someone looking to raise money. Could that be the case? Because I think I've seen projected returns on something sent over to me.
Absolutely. That's common practice. That's normal. And I used to work that way. So I started Sugarhouse in 2017. And for the first 3.5 years, we did not go the licensed broker dealer route. We could talk about projected returns. We raised money off of projected returns, but we had to structure ourselves as part of the GP, the general partnership, so that we could make sure it was in an effort to be in compliance with SEC regulations as far as how we got compensated for bringing dollars to the table. A capital raiser is not allowed to be paid for performance unless you are licensed. And so the way you get around that is make an effort to some level to be part of the GP group and have some level of involvement in the day-to-day operations. That's hairy. The whole industry on the capital raising side, we all got letters from the SEC in 2020 saying, "Hey, we're aware of you. We're not telling you we're taking any action right now, but don't destroy any documents. We just want you to know that we are watching." And that for us was a come to Jesus moment. We went right back to our attorneys. Hey, we thought we were buttoned up on this, but how do we make sure we're double buttoned up on this? And the safest way to go about that is the licensed broker dealer route. It's a hassle, it's a pain, it's expensive, but it does, I think it does, at the end of the day, it does lend me some credibility in talking to a potential investor as opposed to just a straight capital raiser who hasn't gone the licensing route.
So, Rory, I want to ask you this because a lot of the deals that I've heard people are doing that are fantastic deals, frequently they're off market. They're not on LoopNet, they're not on MLS, they're not in the places that people are looking, and those deals are often picked over by the people, and then they end up there. We found some good deals ourselves on MLS, but are these the types of deals that you and your clients, Rory, are finding because they are on these exclusive lists where people are bringing them these deals for passive investments?
Well, I mean, I feel this happens a little bit more in commercial real estate, which is not where I devote much of my attention at all. And that's where really the connections matter a lot more. A lot of things are going to go off of MLS. I've heard that the commercial MLS equivalent is largely where deals go to die, just because they've been passed through these networks in the first place, and then now they're available for the general public to see. Really depends on whether or not which path that the syndicator is taking with the SEC. If they are going to market it, simplifying SEC rules down more than I should. If you're marketing the property, then it's largely going to be limited to accredited investors. Direct relationships, you don't always need to be an accredited investor. So if you want to advertise, you have to have things really buttoned up.
Brad, who are the typical customers of yours who are putting money into these deals? Like, what's their profile?
Yeah, at the beginning, I would hang out at real estate meetups and meet the kind of people who like the idea of real estate, and these are people who like to loan to the fix and flippers, and maybe wanted to dabble in the commercial stuff. From there, then that was helpful for me, and that helped me kind of get things going. From there, I've gone another route where I want to go to the rooms where I am pretty much the real estate expert in the room, looking for folks who like the idea of real estate but don't want to be hands-on even to the level of evaluating a flip deal. So these are, I work with I actually have like 3 ER doctors and several dentists and endodontists and orthodontists, people who are busy, right? Those are high W-2 income earners. They need some tax losses or passive losses on other elements. They don't have the time or the interest getting their hands dirty with the day-to-day management or landlording. I like working with small business owners, having spent the 2000s with the business that I was involved in. We got up to about 14 employees and we were making good money. And that was, so but we went through all the pains of being a company that size because everybody wore every single hat in the company. And I like working with those types of small business owners as well. They're making good money. They're busy. They're wearing tons of different hats. They're looking for passive losses, potential tax benefits that come from direct ownership of real estate. They don't really know where to start. They don't know how to identify, let alone a good versus bad operator. They don't even know where to go find the operators. And so that's what I can bring to the table for them.
Before we hit record, you were talking about some, and good and bad operators is probably the wrong term, but people that are doing capital calls now, or people that haven't adjusted all that well to this new interest rate environment that we're all in. Talk a little bit about that. Like, what have you discovered from some of the deal, I guess, would they be the deal owners, or what's their title there?
The sponsors, the operators, the syndicators, the general partnership.
Okay. Talk about the differences between the people that have adjusted really well in this interest rate environment that we're in now, and some of those that maybe are struggling because they have made some different choices.
Right. So we've always looked at these as we need an operator group that knows how to manage real estate, handle the upgrades, execute the business plan as far as turning this property around or stabilizing it, getting it to an optimal occupancy rate, making a good decision as far as when to refinance or when to sell. What increased interest rate environment has done is to show us we also need these operators to know really well, to be really good at how to manage the financing and the debt when it's fluctuating like it is currently. With the increased cost of capital, many of these deals have variable loans. The interest rate caps have become more expensive, and we've seen some of the operators manage that very well. And one of the things that they bring to the table is deep pockets. So when things become a little expensive, they're not needing to go to the investor and ask them to put up more capital. They're able to fund it themselves. That's huge. Managing it well, having the deep pockets in addition to that has been massive. We have had one operator group in particular, they don't have those deep pockets. Young group doesn't know how to manage those numbers as well. The finance component of it. Their bank was taking them for a ride and they were not sure how to handle it. We actually ended up bringing a couple additional GPs to be part of the operation group to help them navigate it so that we could stabilize it a little bit. That those other GPs brought in some capital as well so that we could make sure we didn't have to go out to our investors to ask for additional capital. But that has put in our minds a little bit of a black mark on that original operator group as far as their experience, their capability to fund any shortfalls. And so going forward, we're going to, that's another element of our evaluation process and our due diligence checklist as we're looking at these operators in, do we want to get in bed with them or not?
Yeah. That makes a lot of sense. I mean, if people don't have the deep pockets right now, or they're just getting started, they might be in a much different position from an established company, and you might think about them differently for the next investment when they're looking for investors.
Absolutely. And I would say, none of these that we're working with are bad operators. The underlying asset is still performing well. They're doing a good job there, but it is a good versus really good. In our minds, I do know some bad. There are bad ones out there, but experience matters, deep pockets matters, and lots of good lessons learned for us over the last 8, 9, 10 months or so.
And then how do you guys make your money? Is it you take like a point or something, or you take a certain percentage off of whatever the investment is?
Exactly. So having gone the licensed broker dealer route, we are paid for performance, and I disclose that to my investors. Here's how I get compensated. It is a percentage of dollars raised, and so I do need to disclose that. But it is very straightforward how we're compensated, and of course, my obligation as a licensed representative means that I can only show that limited partner or that potential investor deals that are suitable to them, their scenario, with a fiduciary responsibility. So is this in their best interest?
And then if you put money into the deal yourself, are you allowed to put money in the deal yourself or no?
Always. I'm allowed, encouraged. I do, because I want to be right alongside my investors.
So you'll make money off of, raising the money, but then if you put money into the deal, then there's another opportunity to make money there as well. Right?
Exactly. In the identical seat that the limited partners are sitting in, anybody that I brought into the deal, I'm sitting right next to them as far as that experience. I got paid up front from having brought dollars in, and I got compensated from the general partner's acquisition fee. So there's no cost to the investor. Their experience is not going to be any different if they go through me or if they went directly to the operator as far as returns go. With me, they get a little bit more of a concierge experience and a little more hand-holding, but their returns are going to be identical because my fees come out of the general partner's acquisition fees. And then from there, with my own my wife and my money that we put into the deal, we're sitting side by side with our investors.
All right, there's another quick take with the Real Estate Law Podcast. For the full episode, go to YouTube or Spotify or iTunes or wherever you heard or listened to that quick take. We also have all of our episodes posted at realestatelawpodcast.com. So on behalf of Rory Gill, I'm Jason Muth, one of your hosts, and we thank you for listening.